G'day Internet, Max right here, and just doing a little bit of an update for the week. Also, I bought some treasury bonds. I'll explain why and how. Talk a little bit about the market, what to expect over the next few weeks, and we'll go from there, okay? So, side note, I hope you've been enjoying Brett Fogel's TA. So, the feedback has been great. You guys have told me that you enjoy him. So what I'm going to do is I've asked Brett to come on as a regular deal on Thursdays. So I basically am not going to make videos ever again on Thursday unless it's some kind of emergency that needs to get out. And I just want to tell you guys, some guys will like Brett and only watch Brett and not me. And some guys will only watch me and not Brett. And some people will like both. All of those things are totally fine. We're very thick-skinned around here. But by making it a regular schedule, I put the power in your hands so that you can check it out. I think Brett's TA is great. I learn a lot from him, so I wanted him to come on. And so he's going to do a regular Thursday thing for me. So if you want to tune into that, make sure you watch the videos on this channel on Thursdays. I'll be doing videos normal sporadically as I do them other days of the week. So, okay, let's talk about the markets here. So we have Bitcoin down 19,300. And I just want to say that although my position remains bearish, I don't think the low is in yet. We are in a massively oversold environment right now. And it creates the potential for a short squeeze. So if you look at the order books and the derivatives data that we have access to, everyone's short right now. Everyone is short. A lot of people are shorting. And it sets up an environment for a short squeeze. What that means is the price rapidly goes up, all right? And it might get up to, who knows, $25,000, $30,000. Very briefly, all those shorts get liquidated, then it comes rocketing down. So if you have a leveraged short position, you want to pay very careful attention to this because this might just happen. Because right now we're in a very, very, very oversold market. All the indicators are saying we're way more oversold than we've ever been. Now, I'm not wildly surprised by that because Bitcoin has never seen this kind of macro environment, so I would expect it to be oversold. So I'm not saying it's definitely going to have this short squeeze. There's just a potential for it, and I want to make sure you're all prepared. So what is a short squeeze? When you short Bitcoin or stock or anything else, what you're doing is you're borrowing Bitcoin from the market to go to the marketplace and sell the Bitcoin, right? You hope the price goes down, you sell it at 19,000. You hope the price goes down to 10,000. You come in a few weeks later, buy that same amount of Bitcoin back for $10,000 a coin, return the Bitcoin to the person you borrowed it from, and you made the profit. You bought it 10, you sold it 19, you just did it in reverse order, you made a profit. That's shorting. But when you do it with leverage, by definition it's leverage because you do not have you don't have the Bitcoin. You had to borrow the Bitcoin. So you are in a leverage position from the get-go. What that means is if the price goes up, you have to have a certain amount of cash or collateral sitting in your account in order to make the person who's lending you the Bitcoin that you go and sell, right? In order for them to do that, you have to have a certain amount of cash sitting in your bank account. Because if the price goes the opposite direction that you wish, i.e. the price goes up, then in order to pay them back, you might have to buy back Bitcoin at $100,000 a Bitcoin. It might never come to these levels again. And so that person's going to liquidate you. What liquidate means is it forces you to become a Bitcoin buyer, even though you wanted to be a seller. It's forced Bitcoin buying, right? Because they force you to go and buy the Bitcoin and repay them the loan which you borrowed in Bitcoin to originally short. So this is an interesting thing. It's very easy to wrap your mind around a cascading situation when people are long. It's just, I've bet for the price of Bitcoin to go up, it starts going down, and you become a forced seller, and it gets a cascade. It's a cascading triggering of forced seller, forced seller, forced seller, and the price goes down. On a short squeeze, it's reversed. People become forced buyers. You have to buy, you have to buy, you have to buy, and the price just keeps going up and up and up and up. That's called a short squeeze. And we are just in an environment right now where that is absolutely a possibility. It's not a guarantee it's going to happen, but it's a possibility. So we are in a very overbought place right now. And so I think there's going to be two likely scenarios in the short term. One is a price-based correction, which would be a short squeeze. It means the price is going to go up here at some point. And if you have a leveraged short position that might affect you, you might get liquidated and become a forced buyer. The alternative is a time-based correction. If Bitcoin just chops sideways here for a few months, even though the price didn't move, now the market's had a time to breathe and we will not be in such an oversold environment. Okay, so there's two ways. It can be a price-based adjustment, or it can be a time-based adjustment. And so one is the price goes up, the other is the price chops sideways, okay? Before we resume this, the continuation of the bear trend. So I want you guys to be aware of that, understand that, so that you can protect yourself if appropriate. You can anticipate it moving forward. When a short squeeze happens, the price goes up very quickly indeed. Okay, something to know. Next, I want to talk about what would trigger that kind of situation. There can be manipulators and whales and all those kinds of things doing things so they can see the order books and try and liquidate people. It absolutely can happen. But there's also some macro environments which might lend itself to that. So let me jump over here and take you to an article on Zero Hedge. If you want to look it up, it's called "The Bullwhip Effect Ends with a Bang: Why Prices Are About to Fall Off a Cliff." And a very interesting article, and there's been several articles of this kind of nature recently. But this graph is a nice little thing to share with you. This shows the inventory to sales ratio in general merchandise retailers. Think Target, Walmart, those kinds of stores. And you can see managing your inventory is a very, very important part for these businesses, right? You always want to have stock to sell, but you don't want to be holding large amounts of stock. You've got the warehouse costs, you've got the security costs, and you've got the sunk costs, i.e., your capital is being deployed here and not elsewhere in some yield-earning venture somewhere else. So you can see this chart goes all the way back to 2010, I think, something like that. And you can see that companies manage their inventory in a pretty tight range, right? But then you come over here and you get COVID. You get lockdowns, you get a supply chain shock, you get stimmy checks, demand soaring at the same time, they can't get supply, and inventory plunges. And this is kind of the reason you get inflation. There's a lot of money chasing too few stock, and all of a sudden you get price inflation, which is what we've seen. So what's happened here over the last few years, and especially recently, just the last few months, is that the inventory at these major retailers has exploded, right? Way higher than they are comfortable with. This is this is normal times, and we're way up above this. So the theory of this article is what it's suggesting is that they are going to start liquidating stock, i.e. reducing discounts, sales, summer sale, etc. And the article predicts you're going to get amazing bargains over the next few months on things that are sold at like your Walmarts and your Targets. Like it's going to be a great time to get a couch on a fire sale, things like that. Because they've got these things take up an enormous amount of room, takes up a lot of money, and they want to just manage their inventory. Now, it could be that they've had a change of strategy from these times, and they say, look, the world is a different place. This idea of just-in-time supply chains is BS. We're changing our model because we don't ever want this to happen again. So we are going to keep inventories up high now. That's just how we're going to roll. That could be the case. Might also not be the case. We don't know if they have had a change of philosophy in that. But we do know they are at historically high levels of inventory. And so this article is predicting that the price of those things is going to come down. Now, here's what's interesting. Those items make up a large portion of the CPI index that we all hear about. Inflation's at 8%. That's the CPI. Unfortunately, the CPI does not take into account much of rent, housing cost, and energy costs. It's all stuff like this. Food, couches, washing machines, vacuum cleaners, etc., etc. And so if this plays out as this article predicts, that you're going to see a massive fire sale in all of these kinds of goods, you're going to see the CPI come down a lot. And this is even predicting maybe even go negative for a few months, right? And so what is that going to do to the system? Well, that is going to signal to the Fed, inflation is under control. We have conquered inflation. Guess what? The stock market's down significantly. The economy is suffering. We see unemployment rising. We see companies laying off people. Hey, Fed, there's no need for you to hurt the economy anymore. Lower interest rates and let's get the economy going again. We are on top of inflation. So that could be a storyline which all of a sudden reverses the price trend of the Dow, of financial assets, and especially cryptocurrency. All right? So that could be a catalyst for a short squeeze. Now, let's just jump over. I mentioned in a previous video the concept of bonds, treasury bonds. And for the first time ever, with a very small position, I'm far from a bonds expert, is I bought my first bonds the other day. And the way I did it with the poor man's method. I did it using this ETF called TLT. Okay, this is an ETF which does all the hard work for you. You just buy it and it tracks the price of bonds. Now, I bought bonds at about 113, and we can see they're here at 115. Now, that's way too early to spike the football and say I did a great job just yet. I don't know how this is going to play out, but let me tell you why I did what I did. The theory is that the long-term treasury bonds, 20-year, 30-year, not the short-term bonds, that's a different animal, but the long-term treasury bonds, all they really do, they're there to predict growth and inflation. Just growth and inflation, that's all they do. And it's because it just does those two things, it's kind of the first market to react. And so we see here, just a very small trend, but just a higher high and a higher low in these treasury bonds. And what increasing value of bond means the long-term prediction for interest rates is coming down. Meaning, maybe, it's too early to claim this conclusively yet. But the reason I went ahead and bought the bonds is because if the long-term view of bonds is that, hey, we've started to conquer inflation, we're going to see lower CPI prints in the future. What that will mean is that the market is saying, the Fed's done its job, it's hurt the economy enough, it's killed demand sufficiently, that the CPI is coming down, inflation is coming down, and they can start easing interest rates. And interest rates, so therefore, the long-term prediction for interest rates is getting lower. When yields get lower, the value of the bonds get higher. It's an inverse correlation. So I wanted to share all of that with you. Like I said, I think bonds are going to be the very first thing. There's been these little relief rallies. You see a relief rally here and a relief rally here and a relief rally here. That's why I say it's far too early to spike the football and say, yes, we've conquered CPI and that's what's going to happen. But it very much could happen. And so with a very small percentage, I think even less than 1%, I bought some bonds just for shits and giggles so that I'm start to learn more about the bonds game. And so I bought some bonds right here at 113 on this ETF. So I wanted to share that with you. So just be mindful. We could end up, we have a situation where a short squeeze is absolutely a possibility. We have a situation where there is some news coming along which would indicate there might be a reason for interest rates to come down. Like we are conquering inflation. If that happens, there's a reasons that the Fed would be able to reduce interest rates. If that happens, you're going to see a resurgence in financial assets, and then all of a sudden Bitcoin could get into a short squeeze situation. So I just wanted to map all of that out for you. I'm not saying any of those things are definitely going to happen. I'm just saying it's definitely something you want to factor into your model. Don't think that a short is a guarantee and we're definitely going in that direction and that's all there is to it. I don't think we're in that play at all, even though long term I am still bearish. All right, guys, let me know. Did you like that kind of analysis and give you a heads up of something to be careful about? Let me know in the comments below. Do you think we're going to see a relief rally in Bitcoin? Will we see $23,000, $24,000, $25,000 Bitcoin or higher? Or is it just sideways or down from here? Go ahead, do me a favor, hit the like button, hit the subscribe button if you're not subscribed, and I will see you soon. Take care. Bye.